Well, hello, Andrew. Thank you for sitting down with me.
Very warm welcome to, I was going to say sunny Scotland, warm Scotland.
We can't see this on camera, but you've got a fantastic view of the castle there. Maybe we can put a clip of that overlaying our conversation at some point.
Sounds good.
But to give you a bit of context on what this conversation is, when I first came to the UK 2 years ago, I brought over from Australia a community format that we had started there. This was a community for public leaders because we found in Australia there wasn't such a thing.
Yep.
And there wasn't really an opportunity for people that run public companies to come together, to share stories, particularly in an environment where they aren't being sold anything.
Yep.
And so we started doing that through monthly dinners. That went very, very well. That evolved to a newsletter. And then when I came over here, I thought, I wonder if the British will enjoy going out for lunch and dinner as much as the Australians do.
And turns out the answer is yes.
Turns out they certainly do. You haven't been to one of these things
yet? Not yet.
Not yet.
Still in the plan.
But started that 2 years ago. We've done about 30 of those here, which has been fantastic. An extension of that was a newsletter that I started earlier this year.
And how many people have been to those dinners now, roughly?
About 200.
Great.
Yeah. And then following the newsletter, there are a number of people who weren't based in London who said, well, I'd quite like to hear the stories that come out in these dinners, but I can't always make it to London for a dinner.
Yep.
Would you be able to profile some of the public leaders that you speak to and share their stories?
Yep.
And so that's what this is. It's an opportunity for other public leaders to hear from you.
Yep.
And I wanted to talk to you in particular because you have a very interesting approach to being on AIM.
Yep.
And you're being very creative about it, which I think is fantastic. And also something that as a market we need to lean into a bit more.
Yeah, and I think that's why the connection with InvestorHub started, because your approach to taking a direct to investor approach resonated for us as a business where we are direct to consumer. We're used to talking directly to the people who are interested, and we found it odd that actually that was more difficult to do. So when the opportunity presented itself, it was a natural fit for us. So that's how we kind of got connected.
No, fantastic. And so maybe before I do want to talk a little bit more about that specifically, but before we get into that, for those that are listening or watching this that don't know you, would you be able to give a brief introduction?
Yeah, of course. I'm Andrew. I'm the Chief Exec of the Artisanal Spirits Company. I've been with the business now for about 5 years, initially actually as the CFO, and then I stepped up to Chief Exec about 2.5 years ago. But I joined to take it through the IPO. We listed on AIM in the summer of 2021. At a time when growth businesses were still, a viable investment opportunity, at a time when IPOs were still relatively common on AIM. And obviously since then, the messaging has moved towards, are you generating profit now? Are you generating cash now in that transition? So been with the business 5 years. Prior to that, I started my career at KPMG in the transaction services department. So working on M&A activity, but from a financial diligence perspective. And then I spent 6 years with one of our clients, actually in the renewable fuel space as finance director, and that was all about growth. So I joined, I think I was employee 65, we were about 50 million turnover. By the time I left 6 years later, we had about 300 employees and about 300 million turnover. So while biodiesel isn't a natural read across to premium whiskey, growth businesses, transactions, that's the bit I had experience of, and from the KPMG days, and the bit I love. There's just something magic about growth businesses that I really enjoy.
It's more exciting. And so looking specifically at your time as a public leader, so being in that CFO, then CEO seat, I'll start by asking, what is the best piece of advice that you have received since taking on that position?
Yeah, I think the best piece, we have an outstanding chair. And when I stepped up from CFO to Chief Exec, his comment was that your job is to make decisions. And that if you're getting 7 out of 10 of them right, you're doing a good job. And that was really helpful. I mean, everyone has their own process about how you reach decisions, the research, the collaborative, whatever everyone's style is. But knowing that you don't have to get everything right, but that indecision can kind of paralyze a business. Ambiguity can paralyze a business. So make the decision, live with it. If it's not right, adapt and flex, but make the decision, move on, and don't expect perfection. Was a really helpful piece of advice.
I think that's really relevant, particularly in a PLC context where this is a regulated environment.
Yeah.
Some might say too regulated, but we don't need to get into the political side of it. And as a result of that, sometimes CEOs I've spoken to in your position can feel like a bit of inertia, like they can't do things in PLC land because of the risk from a regulatory perspective or how it might impact investors. But I quite like, if I'm understanding what you're saying correctly, that the markets will be forgiving so long as you do stuff and explain it and communicate, and not doing anything guarantees that you'll be left behind.
That's certainly, and certainly communication to everybody involved definitely helps to investors. And we've got a good supportive investor base, and more helpful now we can talk to more of them. But also, there are some things where we do make different decisions because we're a listed business, but that's okay too. It's making that decision and moving on, and then being able to explain that on balance, that's a decision that we're living with.
Well, that's actually interesting if we double click on that. So you've worked in private businesses and now public business. What's an example of a type of decision that would be made that you have made differently as a public company versus when it was a private company?
I think an example would be where you're managing a wider range of shareholders. Previous private business, you basically had one shareholder, complete alignment, therefore, across the shareholder base in expectation. As a public company, we have a wide range of investors. For us, we still have quite a lot of legacy investors from pre-IPO who know the business as a private entity, and striking the balance for us on net debt. And we had previously, as a private business, had an investor base who were very supportive of debt, which is quite unusual for small cap businesses, but we're quite an unusual business. We're a whiskey business. We have a kind of £100 million asset base behind a company with a 30 to 40 million market cap. So we have this legacy investor base who are really supportive of net debt, and we'll quite happily see it significantly increase. Then we have the newer wave of investors, particularly people who came in on IPO or post-IPO, who are more used to seeing debt through the lens of current profitability, interest cover, and all those, and striking that balance between the two. And that's where I form my view of what I think the right balance is. But it's a balance. I go neither too far in one direction. Some investors would love us to pay down substantial amounts of debt. I don't think that's the right approach. Others would take us to significantly higher levels of debt. I don't think that's the right approach either. And it's striking that balance between, whereas if we were a private business, I'm pretty certain we would be ramping up debt, taking on more investment, taking on more risk from that perspective, because that's what that investment cohort would want from a private perspective. Is that helpful?
That's very helpful. It's just a much more complicated stakeholder management process and decision making. And you could argue it's better because there's more inputs into the decision making process, which you would naturally expect leads to a high quality decision. But even, isn't it bizarre that if I had $100 million in assets, I'd probably be able to borrow £30 million off that. Just a quirk of public markets.
Well, that's it, and it's the difference between, if you look at the size of our business, we made £1 million of EBITDA last year. We've got the thick part of 30 million of net debt. That's a huge debt balance if you look at it through a profitability perspective. If instead you say you have a 100 million asset and you've got a 30 million debt facility, 30%.
That's not
kind
much.
of loan to value is very low, and that's the balance. Now it's my job to talk to both. I'm simplifying it by saying there's a spectrum, but to talk to both ends of that spectrum to explain why neither is kind of quite right in isolation, and explaining that balance.
That makes a lot of sense. All right, changing tack. This is a hard one. What is the worst piece of advice you have received in your capacity as the leader of a public company?
Fortunately, this is one we discussed before, and I did spend quite a lot of time thinking about it. And in general, nothing came to mind, and I would take that as a kind of positive
Got
sign.
lots of good advisors around you.
Must be, or maybe I didn't realise it was bad advice yet. So we'll wait and see. What was interesting again is around the time that I took on this role, the type of advice was really quite varied. So that great piece of advice from the chair, but actually a couple of bits of advice from two of the board members, both of whom had held C-suite roles in PLCs, were both about taking care of yourself, taking time to exercise, taking time for things that are for you, not for work. And that's, I mean, one of them in particular is an incredibly driven individual. If I'd have guessed how much time he spent, it would round to zero. And he was one who was really advocating for making sure you're looking after yourself, that it's really easy to get caught up. There's so much to it. There is always more you can do to do a better job. You will never be able to do everything that you could do to make it great. But I thought that was, again, I'm afraid it's good advice, but quite left field. Not what I was sort of expecting to hear from people, but I thought really good advice.
And it's probably not something that's discussed much amongst people that run public companies, because it is a very public role and very unforgiving. In that ultimately, in all senses, the buck stops with you. And unlike running a private company, you are to some extent being judged every second of the day whilst the market is open, which is brutal. And in a private company, I mean, at most, you might be judged once a month when you have if you have monthly board meetings with your investors.
Whereas being a PLC, the share price is almost like a scorecard hanging above the door, as you say, every second, every moment of the day, giving theoretically an objective measure of your performance, but it's not.
Well, actually, how often do you look at the share price?
At the start, every few minutes.
In between meetings,
it now goes through waves. I mean, we just did our kind of half-year trading update and sort of tracking it over the first couple of days. Thereafter, not really. I mean, you do need to be aware of it because it matters to your shareholders, and the shareholders are the owners of the business. So even if the conversations are about, here is a strategy for how I think we deliver long-term value from the business. You have to be cognizant that this is people's money. Many people have saved up a long time, particularly when we think about retail investors. Many of this is significant parts of their savings. And you need to recognise, for us, the share price is down well over half since IPO. That's real pounds that people are feeling. Now, they haven't realised that investment or realised that loss in many cases. But they see it and they feel that pain, and so you need to be aware of it. But I'm not tracking it as every minute or every hour to say what's going up, down, left, right. I mean, one thing that I learned about the share price that I guess theoretically I knew but I never experienced, is the impact of liquidity. I had just had no idea how illiquid it could be, and therefore how volatile your share price.
Well, we can talk more about that, because what that essentially means, and I think it's a problem that it's not entirely unique to AIM, but it's much more pronounced here than other parts of the world. And what that means, that dearth of liquidity, really means that accurate price discovery is not happening. And so that can be even harder mentally as a public leader, because you can do all the right things, and for reasons to some extent outside your control, the market doesn't value it correctly. But we can come back to how you guys have sought to address that. And then final thing on the sort of public leader lens, the world is changing very quickly. What it means to be a public leader is changing very quickly. If you were to think into the future about what sort of skills would be very important for a public leader in, say, 5 or 10 years' time that aren't really at the forefront now, what springs to mind?
Again, this is something that I've spent a bit of time thinking about. And if I think about, again, the largest part of my role is about people and people skills. And people skills across all different things. So from shareholder management to board engagement to, as I was saying yesterday, we had a town hall session. We've got about 150 people across the business. I still see that being the critical piece in the future. Maybe the shape of that has changed and evolved. I think what will increasingly be true is people's adaptability. And that balance of many successful leaders, public and private, have a really clear vision of what success looks like. You can see it in a number of places. People who are really driven and motivated by quite a clear articulation of the goal.
And it's infectious.
And it is infectious. And,
yeah.
you may well have worked with people. I've certainly worked with leaders like that who, they're the first ones charging into the burning building, sometimes literally. And that can be infectious. However, you also need to show, I think what will increasingly be important over the next period is adaptability and flexibility to say this core principle, this core vision of success is true, but I'm willing to be flexible about how it's achieved. I'm willing to adapt as the world adapt, as the markets, the conditions, the consumer behaviours, the economic conditions. So I think that adaptability, I think, is the thing that's already, it's already important, but I think we'll just continue to become
I think
more
that's,
important.
I mean, it's a great point, and I want to talk specifically about how you guys are adapting.
Yeah.
But just to, double down on that, and on the people side, fundamentally, public markets are about people coming together to exchange shares and determine value.
Yeah.
And that's not going to change, and it hasn't changed. But to your point, how they're doing that will change.
Yeah.
And it might be the way we communicate, the way we receive information, the way we do something, but it's still people coming together. So I think that's a really good point. So on that adapting to changing winds in public markets, one of the things that you guys have done recently, and the reason why we first connected, was you had this vision for how you wanted to re-energize your investor relations and copy across some of the principles that you had built out in the operating business. So for those that don't know, you're a direct-to-consumer business. So you form relationships directly with consumers. You manage them using data and technology and people. But you wanted to try that on the investor side. Would you be able to give, maybe firstly, before we get into how you're doing that, the story to that, what your strategy is and why you got there?
Yeah. So again, if I think about, objective of delivering long-term shareholder value, for that, primarily, that's going to come from the operations of the business. The business needs to become more profitable, more cash generative. Unsurprising. And we have a strategy for how we believe that can be delivered. And we're sort of often executing that. But in the short term, or short to medium term, there is, my perspective, a disconnect between the value of the business and the share price of the business. And while the principal focuses on delivering the results of the business, because long-term that's where the value comes from, actually there are actions that the company could take to close that gap between the kind of share price-based valuation of the business and the business and the board's more bullish outlook on the value of the business. So what we looked at is how do we close that gap? And we looked across all of the elements. And when we first met, I was talking about that strategy, which included things like going back to our existing investor base and looking at how we get them to continue to be supportive and perhaps increase the holdings, trying to go to the next tier, the people who we've been building up relationships with over a couple of years. What would need to be true for you now to convert, for you now to come in? What are you looking for? What are the milestones? So doing with that. But then looking down and saying one of the challenges that we faced was on liquidity, probably that we touched on before. And our levels of liquidity are pretty low. And therefore, if you are one of the few investors who actually has some powder dry, so has some cash to invest, what we wanted to do was reduce the barriers to entry as much as possible to them, because bringing in new institutional investors is a key part of the long-term.
And that requires liquidity.
And that requires liquidity. And at the moment, the gap between the current liquidity levels, or at the time we were setting out the strategy, the gap between the existing liquidity levels and the levels that they would require to come in was too big. So the idea was, how do we start to build a positive flywheel of liquidity? And that meant starting at the lower end, because we had enough liquidity to support certainly the retail base and some of the smaller PCBs or equivalent. So actually focusing on that retail space and doubling down in terms of retail communications. So more events like Mello, Investor Meet Company, doing more interview, doing more video content and things that
you do stuff yourself as well.
We do stuff. We absolutely do things ourselves. We have shareholder events here. We're actually going to have one in the office here in the coming weeks, where we invite people and just have a chance to have those conversations. But then the connection with you guys, and the timing was perfect, as we were saying, how do we re-energize that base? And you needed a number of pieces. First of all, the website was no longer fit for purpose.
Yeah.
So a chance to reset and to say, what's the purpose of that site? Now we've been on the market for a few years. What are people looking for?
Yeah.
Let's really simplify. Let's really focus. Let's make it easy. Taking that kind of funnel view, like we would do in a normal or D2C e-commerce business, and thinking, how do we bring prospects in? How do we engage with them? Building up a database, so introducing a way of subscribing and coming into that world, and that piece of having regular engagement, the mechanism by which when we put out an announcement, having ways of tracking who's engaging with them, and then how do they then come in, all helped us to drive engagement with the retail base. The final part of that was actually a kind of shareholder benefit program. And for a consumer brand, that's not uncommon. It's not necessarily totally widespread, but it coincided perfectly with this opportunity. We're going to talk more to you. We're going to know more about you as an investor or a potential investor base. But we definitely, at the time of the IPO, when we introduced a shareholder benefit program, saw a really nice read across. I mean, one of the beautiful things about the core brand in the Scotch Malt Whisky Society is it's a membership model. The members already feel like they own the business. Some of them have been members for 40 years. Why not give them some real ownership of the business? So on the IPO, something like £3 million was raised from
the members.
From the members.
Is that right? That's brilliant.
About 10%, and that element was actually oversubscribed.
Wow.
About 10% of our existing UK members bought more than £1,000 worth of shares.
Wow.
So really engaged, and it worked both ways. It drove loyalty in their SMWS membership, but also got them engaged in the success of the wider business.
Just to pause on that, because I think this is brilliant, and this is one of the core things I wanted to talk about. The UK, unlike, or AIM specifically, which is a growth exchange, unlike some of its counterparts in, say, Canada or Australia or the US, has a lot of consumer brands.
Yeah.
And I think this is such a big opportunity because, to your point, it is not just an opportunity to get more investors, because you've got customers who get the business, they're emotionally connected to it, they can tell their friends that they're an owner, fantastic. But you can also get customers.
Yeah.
And so it's sort of weaponizing in the most positive way possible the listing and using being listed on AIM and the public validation and presence that provides as a marketing channel, which is cool.
And it definitely works in both directions. You take members and you bring them even more into your world by making them owners, and then talking to them about both parts. Now that makes messaging sometimes challenging because high gross margin when you talk to investors, when you talk to customers.
Well, they say, where's my discount?
Where's my discount? But actually, it definitely works well in both ways. But also what we found in most recent exercise, there's still a few hundred investors who aren't members. That's another chance to bring them in the other way. So it definitely works really well in both directions.
Do you have any sense of whether that, I mean, we started working together a couple of months ago, you've been doing this for a while now, any sense of how successful that has or hasn't been?
Yes, and the short answer is it has been really successful. We'd always had, or since IPO, we'd had a shareholder benefit program. We basically enhanced the benefits for the existing tier and then introduced a second tier. And there was two parts to that. One was some people were already at a substantially higher level and giving them some extra benefits. But the second was essentially for all those people who came in on IPO, saying to them, not giving them investment advice, but now's an opportunity to double down. And basically, if you made the same investment that you made on IPO again now, you're going to be into this higher tier of membership. What was one thing that was really important when we structured the shareholder benefit program was it had to be sustainable. There's nothing worse than promising people all these great benefits and then having to take them away from them later on.
See, that's a good point, because I've spoken to other consumer brands, listed companies about this, and some of their hesitation is, well, it might cannibalize our existing customer base, we can't afford it. How did you work through that internally?
We thought about what are the consumer behaviors we want to encourage and what are the things that really carry value to members that we're willing to give some value on. So if I pick two examples of that, we give discounts on membership.
Right.
So these people are already likely to renew, but giving them a discount on their renewal because they're a shareholder makes perfect sense. Is a real way, but membership is essentially a zero cost product in its own right. So we are giving up some value, and we were conscious that we were going to sacrifice some value there. But I think that's a fair exchange. But it's always still profitable, and it definitely has increased retention and loyalty of that cohort. So we cannibalized a little bit of our sales, but we've built loyalty and we've built retention.
And there are so many unmeasurables as well, or maybe they are measurable. We could actually look into that.
Yeah, I wonder.
In that, one of the other benefits, of course, is say you lose 10%, but then you get a potential network effect from member investors. They're like, this is fantastic. The next time they're at a dinner party, they say, well, I'm a member of this club and I'm an investor. Tell their friends, come and join me, because they have an incentive to protect their investment and get more people in. And you're locking in a customer. So maybe the lifetime value increases because an investor member, instead of having an average duration of, say, 2 years, goes to 5. And then you've paid for it in many multiples already.
Exactly. And then the other behavior is there are certain products or categories where we want people to engage more. Vaults collection, which is sort of the most premium end of the range. But also for us, most of our shareholders came through SMWS, which at the time of the listing was the business. In fact, when we marketed ASC at the time of the IPO, the strapline was ASC is the owner of the Scotch Malt Whisky Society. Now it has expanded. ASC is the creator of outstanding limited edition whiskies and experiences around the world by having built more of a brand portfolio. But most people came in only knowing SMWS. So actually telling them, you're a shareholder of this, but we're now a family of brands. You get a discount on J.G. Thomson, on the Single Cask Nation, on some of the other brands in the portfolio, which we think people would like, but many of them didn't even know about, is actually a really nice marketing
That's brilliant
tool.
marketing opportunity.
And both parties feel good about it. We get to drive engagement into other parts of the portfolio, and they get great whiskey at cheaper price. So everyone's happy.
That's brilliant. So if you, to a consumer brand or business is listed that has customers, that could be very small customers, very large customers, that wants to try take advantage of that as one, a way to increase momentum in their operating business, but two, to increase liquidity, what would you recommend they do as a first step in that journey?
First step is
other than buy InvestorHub.
The first thing is to make sure that you can build a benefits program which is easy to operate. Nobody's looking to introduce more complexity, more cost into the business. So make sure it's easy to operate. Now, for us, direct to consumer brand is relatively easy because setting up new codes or whatever is, but something that's easy to operate. The second is that it's going to be affordable so that you can make it sustainable. Third bit is that it's going to encourage the behaviours that you want. And I think it's okay not to have to be super generous. We give a 50% discount on membership because of the nature of the structure of business. But for product discounts, it's more like 10 or 20. And we don't give it across the whole range. We give it in targeted areas. And nobody's come back to us to say, we don't like your benefits program. We now have thousands of people on this program. So they clearly engage, and the codes and engagement has been good. So if someone is looking at this, make sure it's easy to operate. Make sure you can afford it so it's sustainable, and target it so that it is a force for good for your operating business. And then you go out and market that, and you find it's a benefit from an investor and liquidity perspective.
I think that's great advice. And even the last point, that you don't need to give a lot to make people feel special and build that community. There are examples in the US where all they've done to affect a shareholder benefits program is given people like a black card. And so making people feel special doesn't need to be a huge expense.
Exactly. And I mean, one of the things that we've done as well is both at IPO and more recently for the kind of relaunch of the enhanced benefits program is we've had a specific time-limited offer.
Yeah, okay.
So we said, if you invest on IPO, you will get an exclusive limited edition IPO-specific bottling. And we've done one of those again for anyone who had gone into the higher tier by the 30th of June. Again, we look at the cost of that in advance. We make sure that that's something that we're happy with, very much are. And the cost of that relative to the other engagement opportunities is good. But also the level of positive feedback that comes from someone getting an exclusive 21-year-old whiskey that only they have comes back in spades. So we've done that twice, and both times that's been really quite successful.
That's fantastic. So look, if there are public leaders who run consumer businesses that are watching this and think, well, this has been successful, I like what Andrew has to say, are you happy if they reach out to you?
Yeah,
I mean, your details are
Yeah.
readily available on LinkedIn and elsewhere. Because I think, just to wrap it up, unfortunate reality is there are a lot of businesses on AIM that struggle with liquidity.
Yeah.
And I believe, I'm editorializing a little bit here, that if we keep trying to do the same old things over and over again, we're not going to fix it.
Yeah.
And I think you're a really great example of someone that's taken a creative approach and it's worked.
Yeah.
And so I think that's a good message to get out there. And I'd encourage anyone listening that wants to try something different, or even if you don't want to, you should. And particularly if you're a consumer business, please come talk to Andrew. But Andrew, thank you for having me here and sitting down with me.
No problem. Thanks very much for your time.
Cheers. Thanks,
Alex. Cheers.